Good evening, everybody. Steve Goodey here. Thanks so much for all turning up on time. Really appreciate that. These webinars take an awful lot of effort, and there's a lot of rush and stuff going on in the background. So we're really pleased to have you all on board this evening. This evening, I have a very, very special guest, Mr. Matthew Gilligan, founding partner of Gilligan Rowan Associates, and he himself has invited a special guest that's kind of like webinar and the guest brings the guest along. So we're really stoked to have myself and Matt on board tonight. And I've been witnessing the carnage that is Matthew putting together his thought process around property at the moment into some slides this afternoon. And it takes quite a lot of effort. But before I get Matt to jump on in there, I'll just let you know that there is a comment section on the side of the screen there. We would love to hear your comments and questions. I'm going to act as MC moderator this evening and grab your questions and pitch them to Matt and our special guest speaker. We love your questions, so just bang them in there. Let's go. I'm also, we've got a very, very special guest speaker this evening. We're going to record this webinar, but we're not going to record his portion of the webinar. This is this very special thing just for the live guests that we have online this evening. And Matt obviously knows some very impressive people, and we're very stoked to have this guest speaker. So we're going to, as I said, record the session, but not record his portion of it. So you guys are very, very lucky to get this. We'd love to hear your questions in there as well. We're also got Gilligan Rowan Associates, in essence, sponsoring this evening's webinar. So we've got some specials and some freebies and some giveaways at the very end, which have been sponsored by Gilligan Rowan Associates. So firstly, thanks for joining us, Matt. We're really stoked to do this.
Thanks, Steve. Once again, a pleasure to be here, and great to see so many people registered. You had a huge number of registrations. So
yeah, 700 or 800 for this webinar alone, but then another like 1,200 historical from the last two in this 4-part series. So a lot of interest, a lot of people sitting there watching on the sidelines, you know, wondering where we are. Basically, are we at the bottom of this cycle? Is now a good time to jump?
Well, be my pleasure to talk about that. Shall I bring my slides up now, Steve? Or are you...
Certainly. I will put those up on the screen there for you. Right, you are live. Off you go.
Thank you very much. Just a short disclaimer on tax. If I talk tax tonight and somebody listens to this recording in the future, just be aware that tax rules change. This disclaimer is out of date. October 2022. It's now March 2025. So if I'm talking tax, the laws change, the rules change. And so it's important that you take specific advice that is appropriate to your individual circumstances. You can't rely on generic advice, which is given in this presentation. So that disclaimer is on foot. For those of you that don't know me, I'm a chartered accountant in public practice. I'm a trust and tax advisor historically. These days, much more of a property investor, property developer, and fisherman. I'd say I've spent the last 20 days chasing marlin, and I've fished in the Kubota up in Mutianga in the last week. I actually won the Kubota a couple of years ago, but last week, alas, I only got one marlin, which I released, and that's one of my great joys is fishing, game fishing for large fish, marlin, and so forth. And then I guess the other thing that I really enjoy doing is developing property. So tonight, Steve, with your permission, I'll focus mainly on a bit of a property market update and go over some of my investments, because in this market, we often hear people saying, oh, nothing's working. But, you know, your good advice that you give your investors, it works for your investors, and the stuff that I'm doing is working for me. So I thought I'd run over some of my investments with the idea that if you come along to Steve's boot camp, you'll learn about those strategies. I'll be there. You can talk to me about them as well.
Yep, love it. And
we'll have a pretty short discussion about tax. Perhaps discuss what the Labor government's looking at doing with tax, because I'm privy to that. And I think we need to be aware of that.
Sure.
So a bit of a market update, property discussion. And then my guest speaker is the very well-respected and well-loved by property investors, Tony Alexander. And GRA would work with Tony 1 or 2 times a year, and he's always on point. So we really like his commentary. So I've asked him to come along, and he's been kind enough to grace us with his presence. I don't know if he's arrived yet, but he's due here any minute. Oh, that's good. And of course, we had the likes of yourself. I describe you as a property entrepreneur, Steve. You seem to be able to turn deals inside out, take lemons and turn them into tasty fruits. So you are a guru in your area. I want to start with a market update. Firstly, by talking about my accounting practice. So we've got 40 people here in Newmarket in Auckland as advisors, and when they're quiet, the market's quiet. When they're busy, the market tends to be getting going. We're a good barometer. So we do a lot of structuring discussions, setting up trust companies, setting up finance structures, setting up JVs. So if we're doing that, the market's starting to pick up. And I'd have to say 2025 is definitely better for GRA. We've got a lot of activity. Clients are in setting up structures, organising finance, and seeking advice from us on their property transactions. So we can see it's picking up. I asked Chris Peterson, who's a finance broker, I said, what's happening in your practice at the moment? He said, large increase in demand. Most bank turnaround times are poor at present. Banks are back staffing up to cope with increased volumes. Mainly buy-to-hold investors and flippers are back in, not seeing much development demand. While there's a large increase in inquiry, this is also being met by a large amount of stock and new listings, so no signs of FOMO yet. So prices haven't moved for a while. Chris comments that Adrian Orr will hopefully mean some relaxed capital rules in the banks, which is a good thing. Debt-to-income ratios, DTIs, are just starting to bite, but it's too early to say how the banks will use their allotment that they can write above 7 times income. Most of the non-bank market is pretty dead at present. Lots of liquidity, starting to see more price competition in the space. So that's Chris Peterson Mortgages, Chris Peterson. So interesting, when he's lending money and his clients are knocking at the door, the market is starting to heat up. A couple of other people I spoke to, Megan Jeffrey Real Estate, Ray White in Remuera. And so they're sort of middle to top end, very, very big company. And their GM, Thomas, says, we've seen a strong March residential market with 81 campaigns across our offices in Remuera, Ponsonby, Aoraki and Green Lane. We've seen consistent bidding with an average of 2.3 bidders per property and good buyer engagement with active bidding. True sign of engagement in the current market is the multi-offers being generated post-auction, properties selling conditionally or going through unconditional post-auction. House prices are remaining consistent. They're not increasing across the board, but they remain steady. There are a few outliers to this. Good quality homes ready to move in are gaining very good prices and activity. Interest rates falling are giving buyers positivity to engage in the current market. So that's Remuera. And West Auckland, sorry to give you Auckland feedback, but I'm an Aucklander. So Calvin Roche from Barfoot's in Auckland, a big agent out Western Auckland, he says that he's seen multiple instances of competitive bidding at his auctions in recent weeks, as well as established family homes being sought, confirming that the market has certainly gained momentum for 2025. The market has improved noticeably with strong buyer activity. 2 weeks ago, he had a standout auction in Mount Roskill, a brick and tile property on 350 metre section with a 200 metre forward area, so a pretty average house. The property featured blah, blah, blah. The CV was 1.3 million. The reserve was set at 1.33, 5 active bidders engaged, and a total of 199 bids were submitted, and the property sold for 1.5. So it's sold, over CV and over expectation. And he goes on to tell other similar transactions. So all that is really confirming what we know at GRA, which is the market's starting to warm up and no surprises. I guess we should start with a positive, Steve. Some very good news. This man's gone. Adrian Orr, in my opinion, the worst Reserve Bank governor ever. And certainly before he went, I was campaigning for him to go. And at GRA, we've got a number of relationships with politicians, as you know. it's interesting. The politicians didn't like him either. He was not popular. So
How do you go from 100 people at the Reserve Bank to 600 and then do nothing and do less? I don't know. Yes, sir.
Yeah.
Retain my outrage.
And of course he went up to Switzerland, to Zurich, and gave a presentation to bankers up there about diversity, and he explained that the Reserve Bank was based on the principles of Tane Mahuta, and that the SAT was the legislation and the leaves was the money he printed and this sort of stuff. It's like, oh Jesus, you've lost the plot when you're doing that sort of thing. I mean, meanwhile Rome was burning. He printed so much money and made it so cheap, and the liquidity just caused massive house price inflation. And then after he got everybody addicted to low interest rates, he yanked the carpet out from under them, pushed them up to 8% to undo his inflationary mistake. And he takes no accountability for it. It's just obscene. So great news, he's gone. And I look forward to a much more steady hand being appointed to our Reserve Bank.
Let's hope. Yeah. Well, let's be fair. It doesn't look like it was his choice to leave. So I think that there was some level of accountability there in the end.
Well, politicians I know certainly weren't engaging with him. They didn't like him at all.
Hmm.
So pretty much mixed sentiment out there we're seeing. Interest rates are dropping. That's positive. Some of the buyers are being limited by DTI rules. And you see that when I'll post blogs and people will come in and bitch about these rules. I saw Ashley Church the other day criticising them aggressively. I actually like DTI rules. If you look at what just happened, we just had the most insane behaviour from our Reserve Bank governor. Let's get back on him again. He set New Zealand up to fail. He put cheap money out there, got us addicted to it, and then he put interest rates up to 8.5%, like nearly triple. So that would just absolutely wreck most economies and most banking systems. But we have LVRs, and the LVRs push so much equity into the market. Average people can't borrow. You've got to be rich. You've got to have 35% to buy an investment property back in the day. And, these rules are prudential lending rules that make this country less volatile and safer. And so I like these DTI borrowing rules because they gives the Reserve Bank another tool. They could, for example, or they could have back during COVID times, they could have said, okay, we're going to make interest rates 2%, but you're only allowed to borrow effectively 50% with LVRs, and your DTI could have been set at 3-1 or something like that. So they could have really clamped down the money supply, but for existing borrowers, reduced the cost. So you can use these quite cleverly. And, Adrian Knoll brought them in, so I'll give him a pat on the back for that. I think they're actually going to...
But I mean, if the Reserve Bank's only skill is that it's a hammer, then every problem it has looks like a nail. So I agree. I mean, if you've got DTIs as well, then, and if somebody's maxed out at, say, 6 properties in their portfolio, then they look at all of their properties and they go, is everything in my portfolio now as good as I could possibly have? And if not, they'll sell one and get something that's better. And I like that. Run to quality.
And the banking system might say the rule stops them from doing something that's going to harm them and cause them to lose all 6. And that is prudential lending. And in New Zealand, I think, outperforms the world in that area, especially with LVRs. So I welcome those rules coming in. Initially, I hated them, but because I thought they were going to affect investors. So there's surplus listings because we've got too much supply, a lot of accidental investors in the market, and rental demand, and is certainly falling in the balance of favour of tenants, with rents softening, as I'll show you in a sec. The coalition government is not polling well, which is a great concern. Personally, I think it's Luxon. He's a very competent man, but he's not particularly likeable at the polls. And it's a real concern to see Labour and the Greens and Te Pāti Māori polling ahead of the Nats and ACT at the moment. When you consider, and I had my investor hat on here, when you consider that Labour tax policy under the hood is clearly to reintroduce interest on deduction. That is one of their stated policies, and they want to seek a wealth tax. They're also bringing in some quite adverse tenancy rules. For example, there's there's a bill that's sitting. It's not a bill. It's in the ballot, waiting to be pulled out from one of the Labor MPs, and it's restricting rent reviews to be one rent review per property per year, even if you have a tenant change.
Yeah.
That's just crazy.
Very dangerous.
Yeah. Yep.
To rent controls, and we've seen, I've seen in my history, rent controls brought in San Francisco where you can't increase the rent, and in New York where you have lifetime tenancy, and you have somebody who's signed up for a tenancy for an apartment in New York and they can't review the rent until the person dies, and the person's 145 years old because the family won't announce that the person's passed away, and it's a precursor to that, which is kind of ridiculous. I mean, we as investors don't set rent. The market sets the rent, what they're prepared to do.
And interest on deduction rules, causes a shrinkage of supply and spikes rents because investors either seek to pass the cost of it on or exit the market. So you get shrinking of supply and rents go up. But I later learned the lesson on that one. That's really bad for New Zealand.
Yeah. And interest non-deductibility creates this situation where everybody wants new build townhouses. And so we have this oversupply of them, and I'm sorry, but most of them are nasty. And they're not great in a portfolio. They're not adding any value. And a lot of people have got one in their portfolio and wish they didn't have it.
Yeah, I got a few of them, but I build them. And I'll discuss it. Yeah, sellers and buyers market. Is it a sellers or a buyers market? Well, there's certainly an increasing number of buyers this year. And I thought they were going to come last year. I really saw it as the bottom of the market last year. And I think it has bottomed out, but there certainly wasn't much activity last year. Lots of sellers are listing. So Trade Me's at a 5-year high in January 2025 for listings. And the market, I think we all know, is strongly favouring the buyers, which is exactly why we should be active at the moment, because there's bargains. You can actually lowball properties. And then we all know that when the market goes back into recovery, lowballs get ignored and you get treated like a leper by the agents. But right now, their incomes are low. They talk to you and they argue it from the buyer's side. So it is a good time to be active in the market.
What is the There's some 31,000 properties listed on Trade Me, 31,063 as of first thing this morning when I did some stats. And I think 8,500 of them are in Auckland. Absolute peak of the market in Wellington had 920 listings. And now that's blown out to 3,600. So the selection is there. It's available.
Yeah. Painfully slow economic recovery, and no wonder, because interest rates were left so high for so long. Or did not read the room. He was living in another world. I think he told me before we started that he was on $1 million a year.
He started at 750. It was well over $1 million a year at the end of the Reserve Bank governorship.
Yep. There's lots of job uncertainty at the moment because the recession's got a long tail in it off the back of those high interest rates. So I think it'd be fair to say that there's no expectations of strong capital gains in the market. But that doesn't mean to say you need them if you're buying well. If they listed it 500,000, you can buy it for 360. You don't need that much for a capital gain because you're getting it up front as you buy. And that number is exactly the number we target in Rotorua Solution. We buy a lot of houses in Rotorua for social housing. We target mid to late threes on houses listed for 5. So factors impacting on the housing market, the job market deterioration looks to be coming to an end, which is a positive. And I'm sure that Tony will tell us all about this when he comes in shortly. Job advert numbers are growing. Business intention to hire is improving. So this is all good, positive stuff. And once employment confidence grows, I think you'll have more people looking to buy share houses and JVs and that sort of thing, which is when the market starts to fire up again. Rents, of course, are very soft. We've got less immigrants and less people sharing houses and willing to pay higher rents because they're house sharing and so forth. It's taking much longer to rent a house, and rents have been dropping. So the national median is up 620 a week in January, but it's been stuck at 600 a week in the past 11 months. And I can say anecdotally in Auckland, a lot of the houses have been renting for less than ask significantly. Yes, like previously getting 600, and then people are taking 520, that sort of money, especially down in South Auckland. So there are more properties offered to rent. People are able to sell their houses, instead rent their houses, or people that have bought and were unable to, they bridged and suddenly they realised they're stuck with it. They become accidental investors. So this is a classic example. One of our crew at GRO found this morning, Maggie. So here's a house that's on the market right now, but then they're giving up and they're renting it out, the same house. So if it sells, they'll sell it. If it rents, they'll rent it. They just need to get some money to pay the interest bill on the house, obviously. So the rents have been ticking up, and then they just hit this wall in 2024 and stayed flat. Auckland in the last 60 days has had no change. Neither has Waikato nor Hawke's Bay, so that's flattening out. Tasman, Northland, Nelson, West Coast have been decreasing, and Otago, Gisborne, Southland, Bay Plenty, Wellington, Taranaki, Manawatu have all been increasing. Interesting to see Gisborne at $50 increase. We were talking to CHPs, community housing providers. They are telling us that they're absolutely starved for housing in Gisborne, so Gisborne might be a hotspot. Yeah, I don't have any houses there. So the thing about migration is it provides immediate demand. It impacts house prices quickly if it stays positive for any protracted period. And last year we saw migration dip negative in the middle of the year, just for 1 month. It's now trending positive. But something I look at when I'm picking an area to invest in, I prefer to see demand outstripping supply. And if you look at New Zealand as a whole, the migration has fallen away and the housing supply has been peaking through a construction boom. So if we graph migration divided by average number of people per house, you get household formation. And if you compare that to consenting, you have demand for housing, household formation versus consenting. So we've been doing this for years and years. If you read my book, we're using these graphs in here. So you can see this blue stuff here, household formation. That big wiggly line is net migration, which is people coming into the country, less people going out. And so if you divide the blue line by 2.8, which is the average number of people per household, you get household formation, which is this bar graph here. And orange is building consents, which is supply. So you can see it's pretty balanced through here. And then suddenly, COVID, we built so many houses, but it's pretty balanced in the last 2 to 3 years. Okay, so that's all of New Zealand. What happens when we start cutting into areas? So let's look at Auckland. We had been making an awful lot of houses in Auckland. So green is CCTs, orange is building consents, and you can see building consents since the unitary plan operated in 2016. Consenting and supply has gone through the roof. There's been a construction boom, and we haven't been getting that many people here. So we're starting to see a significant surplus in Auckland. And you can see the developers are reading the writing on the wall. The consenting's dropping. And more recently, we've had Auckland Council doing some crazy stuff, which we'll discuss, which I think is going to make that even worse. So Auckland Council had been proposing new development contributions on developers. I think I've got a better slide here. So Inner Norwest, you're currently paying $25,000. They want to charge us $98,000. This column here. Their water care will charge you $26,000. So to build one new house, you'll pay $124,000 plus GST for development contributions. And if you go to Tamaki, I've got a 29-lot block of units I'm building in Tamaki. They want $119,000 for a new house, plus 26 is $145,000, which is insane. If my 29 houses in my block of units, if I have to pay 29 times $145,000, it's not viable. I don't build it. So actually, this is a tax grab, and it's dumb by Auckland Council because they're going to crash supply. So we're talking demand and supply, say crash supply.
What's the result of that, Matt? What's going to happen from that? Developers just going to stay out of the market, or are they just going to push the prices higher?
Well, I'll tell you what Auckland Council think, because I've been speaking to some of the people inside there. They think that developers are going to abandon their investment and sell them to another developer at a greatly reduced value, because if you're paying that much more money for the development contributions, then you've dropped the value of the land. And they think developers will go, oh, goodness, I'm buggered, and pass the house to the next guy, and there'll be a reset. That is the exact words that one of the guys said to me.
Wow.
But these guys is like, I don't know, they sit in academia land or something. What happens is there's a second use of that brownfield subdivision. This is infill. That's a house sitting on a piece of land, and it's got another use, the existing use. So instead of falling through the floor and resetting the land value, you just rent it out. And that's exactly what will happen.
Yeah.
So
nothing.
Yeah, so they just cancel their own zoning, and instead of getting, by charging reasonable development contributions, instead of getting all the ratings that they would get off that, and the continued connections that come, they get nothing because nobody builds. So they're cancelling their own zoning. It is just insane. So we looked at these and thought, this is just wrong. So we formed a group called SANS, and SANS immediately had 1,000 people on a WhatsApp thread that I'm on. And there's a really clever, diligent lady called Kirsty Merriman, who is like a dog with a bone. You don't want to get on her wrong side. And she's just been lodging information requests out of council and smashing them. And we, through Lagoina applications, managed to get their development contribution model, which was not available previously, but we managed to get it out of them. And it's flawed. It is half-baked and negligently put together, to say the least. So that is our opinion, but we had it sent to a third party to critique it, and this is a government advisor, and they say the numbers are 9 on 10 bad, if not 9.5 on 10 bad. So that's independent review. So we only got that report last night, and we're taking it to central government, we're taking it to the media to out the incredible ineptitude of Auckland Council, because they're going to crash supply, destroy all of the industry that has been building up during the construction boom. Everybody go overseas because they'll have no work here, right? So your builders, your geotech engineers, your surveyors, your architects, they'll all say, oh, I've got no work now because Auckland Council have cancelled all the developments because they've made them non-feasible. So what happens to these people? They can't starve, so they leave. So they're creating damage to the supply chain. They're cancelling their own zoning, and they're getting less revenue out of it. It's just madness. It's also illegal. It's breaching the local government act. I'll show you.
Well, I'll tell you, mate, I've got a deal for you tonight, okay? One time only deal. You live in Auckland, yeah?
Yeah.
Do you want to swap me as? It's the only time I'm going to offer it. You take, please, yeah, and we'll take yours. What do you reckon? I reckon that's a deal. That's a deal for you.
Are you sure? Our mayor's pretty good. But he hasn't looked at this stuff. But we're
off the table, Matt. Move on.
Yeah. Well, I'll keep way brown, thank you. This will make my point. So here's my development. So on average, a unit will sell for around 700,000. You'll pay GST and agents fees, so you get 600 grand net. And on average, a developer will get 15 to 20%, so 90 to 120,000. That's your normal profit. So the DC increase is, if you've got less than a 100-meter house, you'll pay 80% of those increases I just spoke about. So that will be roughly 70,000, and then they're increasing the water care infrastructure growth charges, so you pay 75,000 more. So instead of making 90,000, you make 14,000, and then you take the interest off. You're making a loss.
Yep.
And if you had higher profits, if you were achieving 20%, you'd be making EBIT, or earnings after interest before tax, of $15,000, which is 2.6%. So you can't bank it. It's not viable. Everything just stops. So when I say Auckland Council are cancelling their zoning, that's what I mean. They are making their developments non-viable.
But we want to let this go, right? What happens here is they put $100,000 more on the cost, and the end user pays for it.
No, well, Auckland Council said to me that their economic advice from their economic advisors say that developers will wear the cost out of the land cost. They won't pass the cost on. That's their economic advice. And
yes, 3 developers are going to go bankrupt. Is that what you're saying? That's how, I'm sorry.
I mean, what that says is that they're willing to drop the land value and effectively steal that money off developers. It's indirect taxation without representation. It's not right.
Yep.
But not only are they taking that money off the developers knowingly to fund development contributions, they are doing so off numbers that are fraud, because we've now reviewed their model and we can prove that it is 70 to 80% more than the actual cost that they're trying to recover. It's illegal under Section 197AB. So we've got a King's Council that we've paired up with at SANS. This is the advocacy group that we've formed. So we've got economic advisors, financial model advisors, and senior counsel. And Auckland Council have got away with a lot for a long time because they haven't had opponents that have lawyered up and formed advocacy that is robust based on proper economic advice and principles. Well, they've got it now. And if they don't reform these TCs, we'll sue them for judicial review and take them to the High Court. And we've got 1,000 developers behind us, and they're funding it through private donations and Give a Little. So it's fraud economic policy. It's the costings are completely inept. You can see this is our proposal that came out last night. Oh, sorry, it's our independent review. And down here, it confirms that they are overcosting by 70 to 80%. And under the Local Government Act, you have to recover a fair and proportionate cost and spread it over the capacity life of the asset. That is what they are required to do. So to try and recover 80% more than the cost and recover it over a shorter period is a breach of the LGA. But we come back on point to supply and demand. We can already see that consenting is falling away because things are not viable and there's oversupply. So with the backdrop of DCs, that would just crash to the floor if they carry on and do what they're doing. So we're opposing it. And in addition, be aware that in Auckland, there's a lot of red zone areas where there's no capacity for water. So, hey, we've got to get the infrastructure on the ground. We're not opposed to that. We just think it should be the actual cost spread over the life of the asset. Whangarei, making too many houses, but this is just hundreds of houses, so it's not thousands, but you can see it's also oversupplied. Yeah. Hamilton is deficit supply, and it looks pretty robust, to be honest. It's the best bunch at the moment. So is Tauranga. Hamilton and Tauranga are both tight for supply, so I think those are good places to be investing. Fundamentals of employment are there and tight supply and demand. Auckland used to look like that. It's loose supply conditions now. Wellington, far too many houses being built. Yeah. Is that your experience? Do you feel like they've got surplus supply in Wellington?
Yeah, I do. At the middle of the last boom, land was just too cheap. You were buying land at $1,300 or $1,400 a square meter that was flat and developable and within 12 minutes of the CBD. And we just oversupplied massively. And then Wellington had its version of the unitary plan that just allowed much higher density. And we can't afford all the things we want. We just want the plumbing to work for a start.
Yeah, I mean, you got real water problems here. We've got the same problem. It amazes me that central government had not put a commissioner in. Like, what's the definition of insanity? Doing the same thing and expecting a different outcome. But they'll tell them to go back yet again and try and form a committee and solve it. Like, it's irrational what the Wellingtonian water people are doing, but it's irrational what central government are doing. They should just fire a lot of them and put a commissioner on.
True, but on the ground, there's some really interesting things happening at the moment. One of the most contentious items, which I'll dip into really briefly, is the Golden Mile project. And they promised it would start in January, which means that they were going to close all of Courtney Place to Taranaki Street, start digging it up, spend $90 million. And they have paused it while they dig up Wakefield Street right next door, and they say that we can't let two main thoroughfares be open at the same time. What I think's happened is we're so close to an election of a new mayor at the moment that nobody wants to put their hand up and start a project that's so hated in Wellington. Nobody wants to get it kicked off and then have the next mayor have to take care of it. And I honestly hope that's what's happening, because the way that government is run in Wellington at the moment, the way hospitality is run in Wellington, you can't close down a major street for 2 years and expect any businesses to be left. It's just sad at the moment. And I love Wellington to bits. I've lived here all my life. I'd love to be able to support it, but wow, big problems at the moment.
You should move to Auckland. Yeah. I better go faster because Tony's waiting patiently. Christchurch looks irrationally oversupplied, but actually, if you go back to 2011, they had 10,000 houses red zoned. So this surplus supply over demand is actually filling this great big hole that got created in supply. Having said that, I still think they're making too many houses in Christchurch. So, there's just so much stock on the market down there. Household income has been growing, and as incomes have grown, asset values have fallen, so affordability is returning to housing in New Zealand. In Auckland, our mixed medium multiple of house prices over incomes topped out at 14. It's now down close to 10. So that affordability is emerging, and then add to that falling interest rates. That's a really positive sign for property, and no wonder we had such a high crash. Here's one of Tony's graphs. Tony, beyond a couple of minutes. Over the last 30 years, the average annual growth has been just over 7%. I presume, is that a straight line, Tony, or it can't be compounding? It seems too high. We'll hear from Tony shortly. He can clarify. But I just think that long-term capital growth is going to be much more muted. We've had a double boom. We're getting a double bust. Makes sense. You had Adrian Orr's, gigantic mistake. Look at the past. The booms have been 2007, 2017. Next one should be 2027, but we had a false boom in 2021 from all of this cash that got pumped into the market during COVID. So we had a double boom, 17 and then 21. You had a double bust. And of course, investors lick their wounds, and it takes them a while to get over that and to forget that. So there's no FOMO, that's for sure. There's ample supply, tight credit still, high numbers leaving New Zealand, political uncertainty, global uncertainty with, Trump and everything that's going on there. So I just expect that this decade will be lower growth than past decades, with less competition buying. So you're getting better deals, and we invest long term. So in 10 years, people will say, how did you get that for such a good price?
Yep.
Well, it's because you're brave and you invest countercyclically. The spirit of these slides is our culture at GRA is similar to Steve's. We sort of say, look at what we do, copy what we do, get what we get. And it's not to say that the team here, Celeste Chand is one of the partners here at GRA, and myself, we invest a lot together in JVs. We invest with our clients too. We do JVs with clients, some quite substantial investments. But we're really open book about it because property is a commodity. If I show you my secret sauce, you're not going to compete with me. There's just too much to be done. I don't have that much capital, and neither do you. So we don't need to have a competition. So we're really open about it. And in the spirit of that, if you are a client of Gilligan Rowe, I'll show you some of the stuff that I've been doing. And if you're not a client of Gilligan Rowe, this is the sort of stuff we get up to at GRA. And in our alliance partnership with Steve, has very good education processes which teach this stuff. So this is one development that I've been doing with one of our clients who's an engineer and a builder. He's a really good engineer and builder, so we partner with him. And we've built these 4 houses. The land and subdivision was 1.5. The building cost was 1.5 for the 4 units, 3 mil, and it's revalued at about 4.5 mil. So equity gain of 1.5 on that. We have rented those to social housing, and they're cash positive on cost. So, 10 years' time, they'll be up 50% of value, hopefully, 55% per annum. So no tax to pay because we developed to hold. You don't pay tax, you don't pay GST, you don't pay real estate agents because you didn't sell. So we did that last year. Same partnership. We're doing this. There was a block of 4. Same partnership. We're building this block of 8 units, Sylvan Road. We're just starting this. So development and build costs is 2 mil. The land is 1.35, 3.4 is total cost, 5.7 is the end value of the units. So the land would have been 2.3 in 2021. That's the key to this investment.
So
And we bought that consented with resource consent and building consent. So they paid their building consent fees as well. But they just ran out of horsepower, couldn't keep it. So we got it. And we've had a few cock-ups in there with Vector because the house in relation to boundary was infringing their safety line. So we had to do a bit of a redesign. So it's a bit slower than we would like, but, good investment. And we'll knock that out this year. Here's another one, Woolfield Road, 68 Woolfield Road in Papatoe. These slides don't scale very well in this Steam platform, unfortunately, but actually this is such a nice investment. Really well-designed houses. I think it's a block of 5 or 6. And we've got a couple of others of these going with similar margins to what I've been showing you, but they're good, healthy margins, close to 30%, if not more. And we're getting it because we're building in a market where no one else is building. So we're getting vastly reduced building costs. We're picking the land up cheap, and it's consented. There's 300 grand with the consenting, 300,000 with the consenting done on the assets. So we get that for free. Get the actual land itself much cheaper, and the build cost is cheaper. And so, sure, we don't get as much for the end product as we would have in 2021, but it doesn't cost us as much. And because we're building at the right price, we then use our social housing relationships, and we rent it to government. Yes, our tenants are going to trash our houses. They'll be destroyed the day we hand them over. Doesn't bother us. We're on long-term leases.
careful.
They'll wreck the place. They'll fix the place. Don't care. It's numbers in a balance sheet and P&L. And actually, social housing is such a good strategy because the government pay the damages. And so they should, because their tenants have done the damage. But the government is your tenant and they subtenant. So they have to deal with that damage that's being done. You get 100% occupancy, and you can get some tax benefits too. So we really like social housing as a strategy. We were in it before there were tax advantages of it. Yeah. I'm doing some land subdivision. I've got a business partner down there in Canterbury, Pete Montgomery. Good fella he is. I don't know if you're online, Pete. But we did these 81 sections down in Darfield, which is mid-Canterbury, just south of Rolleston, south of Christchurch there, 40 Ks. And that went really well. We sold it out. We finished it in 2023, and we're now kicking this one off. You can see that's the 8 hectares we finished in 2023, and now we're doing 450 sections in that 37 hectare block across the road. So you might think, Jesus, how do you do 450 sections at Darfield? Well, you don't. You do 40 a year for 10, 12 years. You knock it out over a long-term period, which is what we're doing. And so we're doing that. If you want to have a look at that, look at darfieldestates.co.nz. But yeah, we're just kicking that off at the moment. This hasn't scaled very well, but I just got resource consent issued for this today, actually. Which I was rather pleased because I've been taking some big swings at Auckland Council, and I thought, gee, maybe they'll put my resource consent on hold. But it's issued. So, yeah, I'll keep swinging because that was the only thing I had out there. But this is a block of 29 units. Now, remember before I said DCs are going through the roof, and it would make something like this non-viable. This is something useful. You'll make money out of this observation. Your development contributions are set at time of application for resource consent. In Tamaki, it's 29,000 for these. If at time of building consent and breaking ground, let's say that they carry on with their insane plan and they push DCs at Tamaki to 119,000 plus infrastructure growth changes. If they push them to 119, I only pay the 29 because at time of application they were 29. Now, councils right across the country try and charge you DCs that were applicable on the day that you apply for building consent. They're not allowed to do that. It's in the Local Government Act. So pay attention to that, because if you're buying, say you buy this site off me, it has significant value just out of that resource consent, because the resource consent is 29 times 60 grand saving off the, the dating of the RC and the development contributions that apply. So, okay, not everybody can develop and do the larger transactions. So here's something that's granular, small, but actually quite profitable, adds up. So we were buying these blocks of land in Rotorua, and you can see the bottom right, that one's got 2 houses on it, and the one above has got 1 house. So that's 2,000 metres of land, and there's on end there, 2,000 metres of land. So on average, we pay $360 to $400 for these, and the houses are run down with stuffed. But this is what development looks like down there. So you buy the house. Buy the house. I'm sorry, this hasn't scaled very well, but the original house renovated will be $475,000 once you spend $150,000 on it. Okay, so we really clean it up and lift it, shift it, and move it. We build 240 metre houses, adds up to $1.8 million, near enough. Original house we paid $400,000 for. We renovated it and moved it, so it's not in the way. We then build 2 more houses at $230 a metre, 140 metre houses. There's 2 of them. That's $660. Subdivision and consenting, about 1.33. End value is 1.88 million, so there's $500,000 in it at 29%. Those are pretty robust numbers. If you're doing single level houses and they're a bit smaller, maybe you get 650 on them, but maybe you can build them for 70 grand less, make a bit more. What do we do with them? Well, if we sell them, we pay GST, income tax, and real estate fees, and you'll turn your 530 grand into 265. You lose half. But if you rent them out, you keep the whole lot. And while Rotorua is building a lot of houses relative to what it was, they're starved for community housing down there.
There's great news coming out of Rotorua lately with development as well.
Yeah. And we're actually in China at the moment, in another business I'm involved in, we're right on the cusp of getting under the new MB program, modular houses built in China, which will be shipped in containers, not container houses, but modular homes that are like Lego. You pull them out and put them up. And so in my 658 grand, I reckon I could get that down to about 17, 18 or $100 a metre out of China. They're not gingerbread houses, they're nice houses. And I'm sure there'll be 100 people saying, oh my God, Matthew, everyone's tried this and failed. We're all over the detail on this. We know what every screw's accreditation is. For credits to Australia, it accredits to New Zealand now. So we've gone through at a granular level, and we're going to start importing houses out of China. And we've got 37 1,000 metre blocks down there. So we're going to do this at scale. Yeah. I was going to do this, but I proposed that I do a bit extra on this at your next event, Steve, and really go over structures, because I haven't done that for a while. I want to go over some of the things we're doing that are saving investors money on the tax front, because we've got a few new ideas. For example, there's a common belief that you can't break tainting. So tainting is association through shareholding and common ownership. And if you buy and sell property and buy and hold property, your buy and sell property taints the buy and hold property with its intention to sell. So buy and hold property becomes taxable if sold within 10 years through associated tainting. Well, we've got some quite clever ideas that we've been working on using tax code that's out there. We've realised we can break tainting. So we've got some good ideas around tainting. Also getting your effective tax impost to 28%. So if you're exposed to 33 or 39%, if you invest the money back into your portfolio through a group of companies, you can retain the 11%. So you get a compound interest factor on that, because you're not paying interest on that 11% that you retain. So I'll explain it to you at the workshop, but we've got ideas like that smart investors are using, and I want to present that at your next workshop, Steve. If you'd like to hear about that, come to our next workshop. I think I'll wrap it there and leave it to your next workshop, but I do want to comment and just reinforce to you that you might not like Chris Luxon. He's not that likable. But if we have the Labor government in at the next election, they're going to bring back interest on deduction. They're clearly saying it.
Yep.
They think it's the way, and they also want to bring in a equity tax, whether it's full-blown capital gains tax or a wealth tax. They're clearly sniffing that area, and they're definitely saying interest on deductions. So I know like people, they're telling me that those rules are terrible. So just be really careful about your next choice of government, because it hurts investors if you get them wrong.
Yeah. And we'll end up like California. Anybody with any money is just going to leave the place. Honestly, it's going to be an exodus to Thailand or something. I don't know.
Yeah, race to the bottom. Yeah.
Yep.
Well, Steve, thank you for inviting me to make this presentation and for having Tony here.
Thank you so much, and thanks for your special guest who we didn't expect this morning, and it was a great addition. He's so well received and so trusted. Obviously, I've got my property update and my event coming on the 30th of March. And you know, I wanted to thank you for sponsoring this particularly excellent ticket offer that we've never done before. But, you know, why would you say that the people online tonight should come along and spend a day with you and I, like, digging into this more deeply?
Well, first thing is you want to be a counter-cyclical investor. You know, and we're bottom of the market. You just heard Tony talking about it. There's not going to be a rush of capital growth, but you can get big discounts at the moment out there. We're getting them. So we picked up, Steve, 2 houses on one title for $360 on 1,000 meters in Lee Street in Rotorua.
Wow.
And that was just before Christmas there. It was a mate of mine's son, Celeste, was going to give it to him. I said, Celeste, what are you doing? There's like 700 grand equity in that property. And he's online tonight because he's one of your followers.
Right.
And I felt a bit guilty, but you know, these deals are out there and they're there for the picking. Once you learn to see, once you learn how to do the transactions, you can see them. And I actually think that's one of the most difficult things in property. If you go out and say, oh, I need to buy a house, well, there's 32,000 listed on Trade Me. Which one do you pick? But hang around with guys like you and you help them develop strategies, and suddenly the strategies filter 95% of the property because it's not suitable for the strategy. And now you're only looking at 5%. Once you can see what you're looking for, it's much easier to find it. And this market is ripe for the picking. The deals are there. We're really active, Celeste and I, at the moment. We've been active in Rotorua and other markets. So come and learn with Steve what you need to do and be brave and invest counter-cyclically. I really think 2025 is the bottom of it, if last year wasn't the bottom of it.
Yeah, it's where the money's to be made. And that's why you and I had a conversation, and you're, in essence, sponsoring my one-day event in a few respects. And I'll explain that right now, if you like. Like, it's a roadmap to property success. We call it that roadmap because we're actually going to show you where you are now, where you need to go, and how one cycle from the very bottom where we are now can change your absolute life. That's why it's so massively refreshed and upgraded this year from every previous year, because it is literally so different right now. And so we've got what I think is a really robust group of professionals on there, including obviously Matthew, my favorite broker, Dave Windler, who's not only a great broker, but he explains himself just so well. And for the first time in 8 or 9 years, I think it is, we've actually got Kirk Ashley coming back, who's a peak performance coach and a success coach, who will give you a kick in the butt as well. And he has some very interesting new stuff to talk about in regards to what he's doing with his book as well, which is just kind of life-changing as well. Obviously, we're going to have our investor panel, which is updated absolutely every year, with some of my top performing clients actually sitting there with a microphone, taking questions from the crowd with exactly what it is that they're doing in the property market right now that's making really great returns. I've got one particular client there who's building 4 properties at the moment and getting a 33% gross return across the 4 property portfolio. And they're going to be in the room answering your questions at the breaks and stuff as well, which I think is really amazing. We're also promoting and pushing a powerful amount of networking. As you'll understand, this has been a 4-part webinar series. We've had around 500 people online tonight. We've brought you one of the greatest bank economists in New Zealand tonight, and Matt Gilligan, one of the best minds in his industry as well. all for free. Imagine what we could do for one full day, but also imagine the power of the other people in the room sitting at tables next to you. And that's why we're sponsoring lunch as well and paying for lunch for the entire room so that everybody can sit there and network and talk to each other and get some details and some ideas and some joint venture partners and some funding partners and spin it around the room a little bit. As I say, I'll leave that up on the screen for now so anybody can grab their last tickets and bits and pieces, and we'll look forward to seeing you on the 30th. Awesome. All right. Thanks so much, everybody.